what you doing? Slap that trade. Back secure, I just got paid. Trend reverse, switch that.
Welcome, Thomas. John, lovely to have you. And Barry, as always. And Abayomi Adoyo. I'm thinking you might be from Nigeria, West Africa, or maybe East Africa. Abayomi, very nice to see you and meet you. We're a fellow African. I'm assuming you're in Africa, from your name. And Achal Kumar, welcome to you, Achal. Welcome to all of you here. Now, folks, we start in a couple of minutes. Let me get rid of the music first. That's a song called Slap That Trade. It's an AI song I made, my latest song. So welcome to the live stream, everyone. Now, I didn't realize when I scheduled this live stream that it was actually going to be on Friday, Good Friday, Easter Friday, because some of the markets are open. Well, the crypto markets are open. It's not a national holiday in the US. It's not a federal holiday, but it is a traditional holiday. So the markets are closed by and large, and everything except for the crypto market. And that's also very quiet. Hardly moved at all today. So what we can do is go through Friday's moves and have a look at the markets, have a look at what we might expect next week. And if you are here on a Friday, on Good Friday, thank you for attending. I appreciate it. I didn't expect anyone to arrive, and the dogs are even excited in the background. So let's get started. It's time to start. Let's get straight into it, and then I'll get some questions, et cetera, at the end, and we'll take it from there. So, folks, this is the currency. No, it's not. These are the Bitcoin charts. Let's go to currencies. So these are the currency charts. And as always, the first thing to look at is the dollar index. And the dollar index measures a basket of currencies against the US dollar, including predominantly the euro, the pound, Canadian dollar, Swiss franc, Australian dollar. I hope I get them all right. And the NOK. So funny enough. So all of those are in the dollar index. The euro is the biggest portion of it. So euro roughly follows the dollar index path, not precisely. I think about a 65% correlation. So this is the dollar index, and you can see we've fallen down into what I've termed Moab. Now we've had the Moab on crude oil, which we'll have a look at shortly. We've broken down through that, and we had a pretty similar chart structure actually on crude oil compared to the dollar index. The dollar index has now approached and actually fractionally closed underneath the swing low, meaning that potentially Moab is broken, barring a fake sort of, maybe this is a fake break, and maybe this will rally up from here after forming this flag pattern. On the 4-hour chart, you can see it more clearly. This is the day chart. There's the move down, bear flag, and tending towards the bottom side after having tried the top only once. We've been testing the bottom on multiple occasions, and in fact have succeeded in remaining below Moab on the close. So pretty bearish for the dollar. And when Donald Trump introduced tariffs on his last round in 2016, the dollar did a pretty similar thing. But the dollar stopped where it is right now. Let's go and have a look at that. If you remember, we had another tariff story back then. Let's have a quick look. We'll have to go to the weekly chart, I guess. And let's go back. It's a long time ago now, and it seems like just the other day, but it's ages and ages ago. Here's 2016, January 2016, where my mouse cursor is right now. And you can see what happened. We dropped from, actually, we were at Moab, and we dropped down below it. It acted as resistance. That yellow line that you can see on my chart, this bar here, is the one that we're currently trading against at the top of, above, as support right now. Look how far that goes back. We're in 2025 now. Look how many times Moab has been tested, touched, probed, tempted, tickled, teased. Let's go back even further. Let's go back to 2000. There it is again, the same line. Lots of consolidation action around that level at 100. That's the dollar index at parity. That's that yellow blob. Where we are today is, so going back to 2016, we actually rejected off Moab and moved down with tariffs from 100 all the way down to 93. We've now moved down after the tariffs. Let's see where we started. We've moved down from 109 to 99, so about 10%. And that was a little less than 10%. So this is more aggressive. And we've also broken down fractionally, agreed, through Moab. But we did see the same tariff sell-offs on the dollar when Trump took control last time, but not for too long. Once we got to the bottom there, we bounced, continued in the range, a bit lower later on, and then up again. Pretty much a sideways range for most of the time. And you can see it's a tale of two cities. We've got the area above the yellow Moab line and the area below that. Currently, we're above it, but not for long. Most of the time, until recently, since at least 2002, we've been below, okay, let's tighten that up a bit. 2003, we've been below that Moab line. Since 2022, we've been above it, but we're now testing it from the top. A lot of people think that the dollar index cannot break down below 100, that it's impossible, that the dollar is already too weak, that we won't move down, that there should be some dollar strength creeping in right now, that it's traditional support and resistance, and therefore it should work again, and so on and so on. However, on the other hand, the other argument is that we spent most of our time in the last couple of decades well below Moab, and I think we're going to try and head back down below there again. First targets all the way down here, lower Bollinger Band, that'll take us back down to 93. The end result of the last Trump tariff war, we got back down to 93, and that's where 93 is, lower Bollinger Band and the first order block. And I think that's where we might be heading to on the dollar index. That means another 7% down, that's 700 pips. And I'd expect in that case for the euro and the pound and the dollar index to move by 700 pips. So having said that, let's have a look at the euro and see what's happened. We had this big sweep. I put this up on X a while back. Big sweep down below support, cleared out all those hands, didn't even get to the lower Bollinger Band before rallying up again, back up through this big order block, and we're now firmly in bullish territory. I know a lot of people are going short on the euro, particularly some famous X's and YouTubers who are perma bears on the euro, but now I don't think is the time to be a perma bear. Fair enough. Over the last decade or two, let's say decade, it's been okay to be a perma bear on the euro, but I think now we're seeing a move higher. If we do see some resolution in the war in Europe, and we do see some resolution in the attempts the ECB is trying to do to reduce rates and the plans that the European Union has to improve the economy, we could see a lot more strength in the euro. Remember I said 700 pips on the dollar index, a 700 pip rally on the euro would take us from our current place at about 1300, 1.13, up to 1.2. That's 700 pips up above us. But let's start with 600 pips, 550 maybe, the top Bollinger Band, 200 period Bollinger Band, and the 78.6% Fibonacci, that's up there. So my best guess at the moment is a 700 pip rally in the euro and the pound, a 700 pip decline in the dollar index. Might not be immediate, it'll take time. There might be a lot of faffing around, toing and froing. We are overextended on the euro at the moment and the pound. And so we could expect some minor retracements, perhaps down to the breakout level here on the euro and perhaps down to the trend line on the pound. But then expect a 700 pip rally. That could take us up, maybe not 700 pips on the pound, but something similar, maybe 500. And let's see where 500 pips takes us on the pound. We're at 3,300 right now. That would take us to 3,800, straight into that order block, the first order block above us, and the top 100 period Bollinger Band. Very similar to what we saw on the euro. Those are my projections for currencies. So I'd say buy the dips on the euro, buy the dips on the pound, sell the rallies on the dollar yen, sell the rallies on the euro yen. That's the only trade that we've got on the yen pairs currently is the euro yen. We're long the euro, and we're also long the Swiss franc. And I do realize that the Swiss franc long, it's not the Swiss franc, it's the dollar Swiss franc. So I'm short the euro US dollar, but long the dollar Swiss franc, which means as they also move they're pretty well correlated. I think they have about sort of an R squared ratio of about 0.9. So they do move very closely together. Of course, there are differences. The Swiss franc being a safe haven for safety plays, particularly when there's war going on and economic uncertainty like there is currently. And that's why we've seen the Swiss franc strengthen so much against the dollar, as has the price of gold. So maybe it's time for this to reverse a little bit. 500 to 700 pip rally on the euro, the pound, and this is a hedge position at the moment. So I've just taken a long on the Swiss franc long because we've reached the lower Bollinger Band, gone right through it, down to this long-term falling trend line, and right here, perfect touch of that trend line goes all the way back to 2003, actually, all the way. In fact, you could take it even further back to 2002. So we touched that trend line, lower Bollinger Band pierced. This is the weekly chart, and I'm looking for a mean retracement rally, I suppose, mean reversion back up there. I do realize this puts me in conflict with my long trade on the euro. The long trade on the euro is actually what I think is the main play, and this long trade on the Swiss franc, and it's quite nice as a hedge for the euro short, for the euro long, in case that one doesn't work out. But I'm trading the Swiss franc as a bounce off incredibly oversold conditions, off a long-term trend line and through the lower Bollinger Bands, with some evidence of reversals from inverse hammer candles and so on. So that's currencies, folks. I didn't want to spend too much time on that, but I did. So I apologize for that. I'll get to your questions at the end, and I'm sure there will be some questions. Right now, NASDAQ and S&P, I've gone over these a lot. Nothing has moved for the last week or so. So whatever I said at the end of last week pertains to today as well, even though it's Easter Friday, end of last week wasn't, but the rest of it is the same. We've barely moved on the NASDAQ, even though these moves are massive, huge intraday and daily ranges, they're dwarfed by this 15% rally that we had some time ago, about a week ago now. In fact, was that Monday? Can't remember now. It was Wednesday, sorry. So Wednesday week, we had this massive rally. Now, since then, and that was a 15-point-something% rally, bottom to top, biggest in NASDAQ history. But these moves subsequent to that have also been very, very big, but they're dwarfed by the ridiculously outsized move. My feeling on this is that I have no clue what's going to happen as long as we're below this trend line, the 20-period moving average, and this recent spike high. In other words, this purple range that I've got drawn in here. Until that breaks above, I'm going to be looking short. And until we break down below the bottom, I'll be buying the dips on severe dips, big dips, super dips, if you want. So I'll be buying dips, big dips, and selling rallies, big rallies. Currently, it all sounds great. What a great plan. I have no positions in place except for one hedge very close to each other, a long and a short, pretty much just a few hundred pips or points away from each other. So very, very close. We were lucky to get out of that. On the bounce, I immediately hedged my long position and managed to cover most of it. So that one's out of danger. Same with this S&P. We also hedged that one on the retracement. So we're basically out of the market on these with small floating hedged losses, which are relatively insignificant. I've got to make a decision one way or the other as to which way I think this market will move. But once again, on the S&P, we're below the 20 period, 50, 200, and 100, and below the trend line. We've also got a golden cross. No, wrong. A death cross. It's the opposite of a golden cross. When the 50-period moving average crosses down below the 200, that's what's happened here. The red crossing down below the purple. And we've also got a death cross on the NASDAQ. Now, before you get all bearish on me and say, well, that's a death cross, it's all over, there's the death cross on the NASDAQ right there. And before you say it's all over, most of the time, not most of the time, I'd say more than 50% of the time, significantly more than 50% of the time, probably closer to 60 or 65% of the time, when you get a death cross, it's actually a bullish signal because it's so lagging and so slow that by the time that cross has occurred, you've got to get a 50-day moving average moving below a 200-day moving average. That's a very slow moving container ship-like process. And by the time that's completed, very often the market has already changed direction, starts moving back the other way. So don't worry about the death crosses. I know you'll have seen it all over X and YouTube recently. Death cross, death cross, death cross. That's all you'll ever hear right now. It's not necessarily a bearish signal. In fact, if you were even slightly contrarian, you'd regard that as a positive and bullish signal. But for me, until we get out of this purple range, we could draw a similar range on the S&P. Until we get out of this purple range, I'm going to be trading from the bottom to the top and the top to the bottom until the market proves me otherwise. So I've got two lines in the sand, and basically defined by that big move down, the bottom of that big move, and then the top of the retracement rally. That's it. Pretty simple. And right now, even though we have two positions on, small positions, they're also very close to each other. So basically, I have a very small floating loss, but it's insignificant. I might as well just close those trades. But I do like to keep hedged positions open. Personally, it's my own quirk, I suppose, but I like to be able to have a foot in the market. I don't like to be out of the market. And I like to be able to have a hedge position in place. If I don't go out to hedge on purpose, but if I do have to be hedged, or if I think hedging will be advantageous to me, I don't mind being hedged once it's actually happened, because I can then use that hedge to either sort of edge my way into one direction or the other by taking small amounts or adding small amounts onto either side of the hedge and starting to adjust the balance of that hedge so that it's no longer equal or balanced, and so that I have a directional bias. Right now, I have no directional bias on the NASDAQ or the S&P. It possibly is short, but I was waiting for the end of this week to see how this week closed to have a look at the weekly candles. So let's do that because it is Friday and the market closed yesterday. So because it's a holiday, let's have a look at the weekly candle. And all you can say from that is we've got a tweezer top there. If I move that arrow out of the way, the hedge arrow, that's my position, one there and one there. If I move that arrow out of the way, we end up with, is it a tweezer top? No, it's not a tweezer top actually. So nevertheless, it's an inside bar. So in other words, we traded within the range of the previous week, which is not surprising because the previous week was the entire range from 19,200 all the way down to 16,200. I've never seen such a thing in my entire life. Not once, never, not at any time have I seen the market move 15% in one day. So we had an inside week, which means we may get a continuation of the last week move up, or we may get a continuation downwards. The week before, though, I want to point this out, even though it's an incredibly volatile, messy, and I'd say unpredictable, violent even market. This is a piercing pattern candle reversal setup. In other words, we made a new lower low, and then we closed more than halfway up the previous week candle's body. So that's called a piercing pattern. Go and check it out in your Steve Nissen handbook and check that out. But it's a bullish reversal pattern. But considering everything that's been going on this last couple of weeks with the Trump tariffs, we still don't know what's going to happen next. And we're still below this trend line, and we rejected from there sharply. So given all of that, I still don't have any particular directional bias. I'm not going to repeat the same for the NASDAQ because the same things apply, which I've just spoken about for the NASDAQ, the S&P. We're also long on a few names here, MSTR, Tesla, Coin, and Google, and actually all holding up better than most of the market. And that's just pure luck, folks. I picked those. We've been in those names for one reason or another. MicroStrategies, Tesla, Coinbase, and Google. And I'm looking to buy Target, by the way. I'll just put this up here. And those names I just sort of got into by luck, by chance, and by selection, of course. But those seem to be in the strongest by a little bit of luck, bit of a fluke. This is the target chart. I just want to point out one opportunity that I've been pointing out on X. This is the long-term pre-COVID trend line, this black line at the bottom, and there's the lower 200-period Bollinger Band. Look how massively we moved down, but only to the trend line. It's a very important trend line. This is the post-COVID rally. Everyone is sitting around, spending money from inside their houses and not doing anything else, spending all their money at Target. And they stopped spending their money at Target now with inflation it was at 8 or 9%, I think, at one point. And so stop spending the money at Target. But now it's time to buy Target shares again. We're back down to the pre-COVID trend line. It's a nice, gradual, slow, ambling up stock. And it's probably a really good place to buy if you're a long-term trader as well. So just another little opportunity there. We haven't got a position on that just yet. I'm just waiting for a little slightly lower dip down into that 200-period moving average. Now, Bitcoin and Ethereum and XRP, just to reiterate, nothing's really changed. As you can see, for 5 or 6 days, we've been moving exactly sideways on Bitcoin, similar on XRP, similar on Ethereum. But we are holding up really well compared to the rest of the stock market. And actually, we've regained this long-term red trend line, and we've held it for a number of days in a row now. In fact, 1, 2, 3, 4, 5, 6, 7 trading days, which are every day of the week. So 7 days, exactly one calendar week. We've moved nowhere, but we've held that trend line, fractionally higher lows on every occasion. So looks pretty good, pretty constructive. Our next target for Bitcoin, let me just show you, is, well, it's not very complicated, actually. I think I'll go to the futures chart for this. Quickly have a look at the futures. Futures looking good too. Tweezer engulfing daily candle bottom there. Bullish engulfing candle, actually another piercing pattern candle, and a hold above the trend line so far. Our next target really is up into this zone here, the underside of this flat bottom breakout region, and that's at about 94 to 95 to 96,000, perhaps starting at about 93,000. So into that zone there. And in fact, I'm going to put a line there just to remind me. For some reason, I deleted it. And I want to put it under the bodies of all of these candles where we just didn't close beneath. So kind of put it there. It's a rough estimate. So a close above that line, well, that's my first target. And a close above that line will put me incredibly bullish on Bitcoin, looking for the next move up to the recent highs at around 110, and then higher than that up to maybe 180. Anyone's guess, really. Blue sky above us. I'm not going to call any particular target levels. Let's just double where we got down to the bottom. We got down to 75, double that, 150. Let's go with that. Sort of simple doubling. We're also now short on gold. We added our next tranche on gold at the top there. That's our average price prior to this entry. And so we've got a short there now too. And at the same time, and fortuitously, we took a profit on silver. We were long silver at the same time that we were short on gold. It was a hedge trade. We've now taken a very, very big profit on silver, and I've used that profit on silver to cover this short on gold, which was premature, but I held on to that trade knowing that it was covered by the potential gains in silver, which often tends to move in tandem with gold, and actually had the opportunity to catch up a little bit after having dipped down much deeper than gold on that last dip. Compare that dip on gold to this dip on silver. Dip on silver was much bigger because gold is almost purely an investment metal, whereas silver is an investment metal, but it's also an industrial metal used in a wide variety of industrial applications in production. And because of the tariffs, silver got smashed more than the rest of it. rest of the precious metals. Let me just get rid of my private group now. And so, yeah, so fortunately, I covered my short gold risk with a long silver position, which moved up faster than the long gold position. So I made more profit on the long silver, even though I had a slightly smaller position size. And I've now taken profit on the silver trade and exited that and added that into the pot to cover the risk on the additional tranche on my gold trade. I want to show you what this gold trade looks like on the 4-hour chart. And we've got a classic one up, one down, reversal candle pattern. 75% of the time that will work out and this market will move down, but 25% of the time it won't, and we could move higher. We're now no longer covered by the silver hedge, which means I'll have to manage this risk much more carefully, particularly if the profits from the silver hedge start to run out as we move, and if we move higher on gold and start to eat into more of those profits. So for now, okay, we've got a one up, one down on the 4-hour chart. We've got a hanging man candle pattern on the daily chart, which is cool. I think we could move down from here. And silver, we're now completely out of. We're long on XRP as well, long from the bottom there. We're long on Ethereum, and that's the Bitcoin futures chart. Going across to energies. Now, if you're not part of my private group, you will not know this, but we are now long on natural gas again. But I'll get to that in a minute. We're also long on uranium. I want to show you what the uranium futures look like. You can see we had doesn't look like much, but it's quite a nice little rally on the uranium futures, not reaching down to the 200 period moving average and the Fibonacci level where I've got my blob drawn, not getting quite down as far as that. And I'm allowing for that to still happen. But considering we didn't get down there, and we've made a little, this is a weekly chart on the UX1 Shriek uranium futures on the COMEX, and we have made a little bounce there on the weekly chart. Looks very small, but it's better than moving down. And as a result, the URA ETF, which is the one that we're currently trading, we also trade UEC on occasions, UEC, but we're not currently trading that at the moment. And we are now also long on the URA ETF. I will consider adding more once we break and close above the 20 period moving average here on URA and add more to my slightly underweighted position on this, but there'll be plenty of opportunity next week. I'll get to natural gas shortly. We're still long on Brent crude, although we're not trading Brent crude, we're trading WTI, and we're trading it on the ETF at Black Bull. Well, I am in any case. I'm looking for us to get back into Moab. This is our other Moab, very similar to what we saw on the dollar index. I'm waiting for a move up to 65.5, which is somewhere into Moab, just the bottom of Moab, really. And then I will exit that trade and reverse to short, looking potentially based on price structure, price action, the way things look at the moment, at the time, and the way we trade around the zone, and then potentially looking for this to bounce down off Moab again, back down for at least one more test of this longer term channel line. And then if we do manage to break down below there and move lower, then we could see a much bigger drop into this void down below here between that channel and this falling trend line. So that's WTI, and I guess we'll take profit on that early next week as we move up. Could even be, Sunday night or something like that. Now, natural gas, I'm not trading the futures anymore because the futures roll over next week, and I don't trade in the week before the rollover on the futures. But I do trade the Nat Gas Pepperstone ETF, and if you are interested in Pepperstone, there's a link below. If you sign up with that link, I'll get some pennies from your trades. But I trade my continuous contracts here. And what we had on Friday, very late, was another one up, one down candle. We've also got 3 falling spike low candles here on this chart. One there, slightly lower, slightly lower. That's a one down, one up reversal candle at key support. Now, I want to show you on the futures because remember, I'm trading that on the continuous, not the futures. But I do keep an eye and continue to watch the futures chart. Futures chart doesn't look quite as positive with that candle moving down quite rapidly. They're the 3 spike lows. There's the one up, one down on the futures as well. And the 3 spike lows getting progressively lower, and that's created divergence. I don't have it shown on here, but on the RSI and the stochastic, if you put those up on your chart, no doubt you'll see a stochastic or RSI or MACD divergence. And so that's another thing you can put into that equation. However, we are below the 20 period moving average. That's the green line on both of these charts, and this is looking pretty weak. And so if we do close beneath that last spike low, in fact, I got mine just below $3 because I'm a little worried about $3 as support. But I will do another video to give more detail on this on Monday. So don't worry about the details too much. Just to say that we are long and I have a stop and potential reverse plan in mind. I'm not exactly sure what that level is. At the moment, it's just below $3 at $2.97, but I might raise that and put it below this spike low, depending on how we open up on Sunday. It's only Friday today, so there's a couple of days to go before this market even starts to get going again. And that's it, folks. So nothing on the futures. We'll get back into the futures after the rollover. Overall, the COT report has come out, the new COT report. Go and check that out, and you will have noticed that there's slightly less open interest. More people are getting out of the market as we approach the contract rollover, but there is a kind of an angling slightly to the long side. If you look at the commercials, the producers, and the managed money, all shifted, not fully and not committedly, but shifted slightly to the long side. And maybe we'll just get another bounce up to 375 and then back down again. I don't like buying at this level, but the chart's showing me that this is what we should be doing. And it's only got a 75% chance of being right. So 25% chance of being wrong. I'm accepting that risk, no problem. It's a small position too. Now, target's 375. As long as we're above $3, particularly 350, 375, we're at 326 now. So it's not a bad position to be long. But if we're at 350, 375, I want to be looking short most of the time on natural gas. All right, going across the 10-year yield and the VIX and TLT, 10-year yield ticking up again, and TLT ticking down again. So still not a great deal of interest in these bonds, treasuries, and so on. And then the VIX just ambling down, still well above 28, actually almost still at 30. Can you believe that? So we got a massive move up there with the tariffs, dribbling back down again as we see the stock market beginning to try to make sense of what's going on. Are we going to recover, break out through the top trend line on the NASDAQ and the S&P, start moving higher and maybe even onto new highs? Who knows? Or are we destined to be stuck in this range for the rest of the year and we won't see much more out of the VIX for the next 6 months because we won't be sort of looking at major tops or bottoms? Perhaps. We don't know. It's all speculation at this point. We'll find out as time goes on. And then going across the softs and grains, finally, final chart, final page. Sugar. We're long on sugar. We just took a new tranche on sugar, reaching back down to the channel center line. We've got 2 tranches on there from earlier. We took some profit. We took half off of there. We added 20% back on. Sorry, we took half there, took off half profit there, added 25% back on there, added 25% back on there. So we're back into that position that we took off, and that's all. So looking for a move back up through that trend line. We're still long on corn. Let's go through them one by one. Corn, so we took profit up there. We got long again at this trend line. We got down below the trend line. We are actually in profit, but still not above this trend line. We did try, didn't get quite above it. But anyway, looks okay. Not very exciting. And then the other one that's also an interesting, languishing long-term trend is cotton. And at least we've broken up above that trend line. Look at all this volatility on cotton. And this means we're ready for a breakout. So all so neat and beautifully trading within this channel. And then it slams into the bottom, slams back up to the top, back down again, smashes up through the top, all the way back down to the bottom, all the way back to the top, breaking out, back in. So a real, going from peace and tranquility and quiet, quite a long time, we get this enormous amount of volatility. That means that we're probably, not definitely, probably changing direction. And then the targets, you can see the red, the green, and the black lines above us for cotton. You can check those out on your own charts. We're looking for a short on orange juice. We don't have one yet, but looking for a short into some of these levels, maybe early next week, actually. Monday might be a good opportunity right there at about 320 or so, a short on orange juice. A target for orange juice, a long way down below us, actually. You've got a long way to go on orange juice. And this is still incredibly overbought. And we should be, it's not that bad, actually, but it's still pretty high. But we should be closer to sort of 200, maybe down into 150, 160, 180. But we're currently still trading at 311. So, yeah, perhaps another leg down and then a bit of sideways range trading for a period thereafter. We're also long on wheat, and wheat has also just been languishing despite the Ukraine and Russia situation and various other instigators that should have driven this up. It has still not risen up, but there we go. It's not going down. It's not going up. It's not very interesting at all. And then cocoa and coffee. I'm looking to sell cocoa. We haven't had a chance yet. We should have sold there. I didn't. I was remiss. That was the obvious place to sell more. We took all our profit on cocoa. We got short at the top here, if you remember. We had some hedges starting up around here. We got out of those hedges. We took some shorts, and we got out of these trades, I think, back into this yellow block. We did. We actually got all the way down here. We took some profit right at the bottom here, if you remember. We've now rallied back up there, but we should have sold again. But maybe we'll get another chance, maybe even slightly higher. Be looking to sell cocoa. We're still short on coffee, and I've just added last week on Thursday my second tranche, or re-added my tranche. Let me just quickly, visibility order. We want that up front. So if you remember, we were short the whole time. We took profit down here at the channel line at the bottom on coffee. We took 50% off there, and I added that 50% on back there, just underneath that line there. where that horizontal support level is. Let me draw a line in there just to show you. Just underneath there, just like that. So I took another short position there. So we were short, took 50% off, added that back on right there a couple of days ago, looking for a move back down to the channel line, the top of the channel line, then into the channel, and then below the channel down into some of the lower regions, perhaps in 200s. We're currently trading at 380. So anyway, that looks pretty good. A little faffing around on Friday, didn't really move up or down, just a hanging man. It is a bearish candle, bearish reversal candle. So perhaps with a bit of luck on Monday, that'll start to move down. And that's all the softs and grains, folks. We've covered currencies, we've covered stocks, we've covered gold and silver and crypto, we've covered natural gas and oil and the US10Y, etc., etc. And I think that's everything. Let's go back to the live charts, the ones that are least currently ticking. Get this up on the screen, not that one. And I'll get your questions. And while we're talking about questions, we may as well watch a live dancing 15-minute candle on Bitcoin as it ticks up. Then we get to the questions and the answers and the comments. All right, I'm going to start at the top, folks, just to make sure I haven't missed out anything. Good day, Thomas. Yeah, have a blessed Friday to you too as well. And no problem about the trade ideas. Good day, Barry. I did say hello to you earlier. Thank you very much for being here. And once again, folks, I didn't realize this was a holiday when I set this up. I should have realized. And by the way, I'm going to be doing for members only, these live streams I'll be doing for members only, members of this YouTube channel. You can join for $1 a month. And I'm going to be doing live streams for members and all sorts of other perks. I'd highly encourage you just to sign up and just, you can do it for months if you like it for $1. It's worth it. And I'll be doing these sorts of videos for members only. We're also giving out some merch, and we also have some discounts on training courses. We have some special members sessions lined up, webinars and that sort of thing. So stay tuned and make sure you click the join button below this video right now. It's $1 a month. It really is worth it. If it's not worth it, then it really has to be terrible if it's not worth $1. So go and do that. And thanks for being here on a Good Friday. Good day, Ashal Kumar. It's wonderful to see you. And Royston, good to see you, Royston. I had a good friend whose surname was Downing. Hello, Ichtalt. Hi, Nigeria. Lovely to see you, Abayomi, my brother from Nigeria. I'm from South Africa. Jimmy James, Ray Kane. Lovely to see you, mate. Jimmy James. I wonder who that is. That seems a little cryptic. Moonstone, great stuff, James. Thanks, Moonstone. Surprised but happy to see your stream. Thank you, WK. Manatee Orange. I suppose you're surprised that it was on a Friday, but there you go. On Easter Friday. Good day, Manatee. Good day, Royston. It's a pleasure, Royston. Very enjoyable, as you say. Happy Easter to you and everyone. Happy Easter to you, Royston, and everyone else as well. And I hope you enjoyed it, folks. It's just a quick catch up. It's always nice to sort of touch base and to see someone if you've been watching the markets and you're interested in what's going on and you enjoy the content that we produce. Let me see if we can go full screen. Yeah, so that's it, folks. Have a great Easter weekend, I suppose. Even if you're not a Christian, or if you don't celebrate Easter, or if you are a Christian and you think Easter is pagan, you can still have a great time with your family and your friends. Go to the beach, go do some fun things, go for a meal, do something special, listen to some music, dance under the moonlight, swim in the sea in the middle of the night, go skinny dipping, whatever you want to do. Have fun this Easter, no matter what your religion, no matter what you believe, and be kind to people, be nice, be kind to your mother and to your friends and your family and so on, and just have a wonderful Easter weekend, no matter what you believe, no matter where you are. And it's Good Friday. Yeah, Good Friday. Yeah. So you also forgot, there you go. You also forgot Manatee. So yeah, it is Good Friday, folks. And it's been a hell of a week, and it's been really difficult trading, I have to say. We've been quite fortunate, mostly on the NASDAQ and the S&P, because we were able to hedge and cover all of our losses on the, after that tariff situation. So we're fine on that. And we're still basically sort of long on the stock market because we have long positions on names. We're hedged on the S&P and the NASDAQ, but I've got long long Coinbase, MSTR, Tesla, and Google. So we are still long the stock market, but very, very cautiously so. So it's been a very difficult week for a lot of people, maybe a week from hell. And I hope next week and after Good Friday and Easter Monday, it'll be a week from heaven for all of us. So take care, and I'll see you soon. Yeah, that song you were listening to earlier is one of my AI creations. Okay, I don't know how to get. I'm on the wrong screen. Don't worry about it. So let's get on with some more questions. Just last comments. Good Friday. And Achar, 75% chance for natural gas to go up and 25% chance to go down. Can you talk about the 25% chance for going down? Yeah, so basically, I'm not saying that. I'm saying about this candle formation. So please don't quote me on something I didn't say. But let me just go back to my charts. Yeah, so what I actually said, and it's very important that you're precise and concise when you repeat something that someone may have said, or you say something yourself, make sure that you're accurate about it. I didn't say there's a 75% chance of natural gas going up. I said this candle pattern here, the one down, one up, has something like a 60 to 70, I actually said 65% chance, maybe 75% chance of reversing and this price moving up. So it's all based on probabilities. Nothing is cast in stone, set in concrete. Nothing works every single time. Nothing is 100% guaranteed or anything like that. Over time, you'll observe that these candle patterns, this particular one up, one down, has a very high probability of reversing the direction of the trend. The current trend is down, and this is a reversal pattern at the bottom of a trend, below the 200 period moving average, but at support. We talked about the support level here at roughly 3.2, roughly where we are at the moment. Now, because we have let's say it's as high as 75%. I said 65 to 75. So let's take 70, which is my actual trading success rate on average as well, interestingly, 73%. Over tens of thousands of trades, it's about 73%, 73.2, something like that. So this pattern here, but so when I say I have a 73% chance of winning every trade I take, it means that out of every 10 trades, I lose 3. Out of every 100 trades, I lose 30. It also means that I could lose those 30 trades all in a row. When you say on average, it doesn't mean that the distribution is equal and that they will be interspersed, the losing trades, that they'll be interspersed equally throughout those 100 or 10, whatever number of trades you're counting. Sometimes they come in clumps. Actually, very often they do come in clumps. So if we've had a pattern like this and we've measured or estimated that we have a 70% chance of this reversing and being a winning trade if we buy at this level, then that means that 30% of the time we'll be wrong, which also means that if we did this 10 times in a row, we could be wrong 3 times in a row, or 4 times in a row, or 5 times in a row. Sometimes you could get 6 out of 10 trades being losing trades. You could have a losing streak within that average of 70%. So out of every 100 trades, you lose 30, you could lose 10 trades in a row and then lose the other 20 at some other stage. So I'm not saying that this has a chance of going up and that it's something you can count on, bank on, go FOMO on, go YOLO on, load the boat, back up the truck. You can't do that. That doesn't mean that this is definitely going to go up or definitely going to go down. It's some sense of probability. That's all. So you're saying, what if it goes down? What happens next? Right. I get your question. It's a good question. Look below us. We've got the 200 period moving average right here at 3.05. That was my initial target, if you remember, $3, but I made it 3.05 because the big 200 period moving average is here. But the $3 level is a big key fundamental round number as well. And I'm going to draw a line right at $3, a horizontal line, as close as I can. I'm actually going to change this to black, and let's make it slightly thicker. So that black line there is my initial target. We haven't got there yet, and I've now reversed direction without having reached my target. If we do carry on moving down after this weekend, I expect the first stop will be my initial target, 3.05, the 200 period moving average, or the big $3 round number, where the price has reacted multiple time and time again. Right there, that black line, $3. It's reacted there, 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 and so on and so on and so on. And we can go back forever and ever and ever. $3 is always a crucial number. So that's where we're approaching right now. So if we were to go short right now, there's very little space between our current price and maybe 18 cents with a spread, or maybe 12 cents or 13 cents, depending on how you get in. If you get in late or early or whatever, you might not even get more than 12 or 15 cents out of this move, which means that in order to get this move, you've got to risk at least 12 or 15%. So your risk reward ratio is only 1-to-1, and it may not interest you at that point. Certainly doesn't interest me to go short, knowing that we can only get as far as $3 potentially. Doesn't mean we're going to stop at $3 because there's loads of space below there. But we'll certainly hesitate there, and we'll certainly try and bounce or try and get through one of the two. And I want to be there when it happens, but I don't want to be committed one way or the other. And so I don't want to be shorting necessarily now. I don't really want to be buying either. So I've gone with a very small position, and I've got a tight stop or hedge. I hedge. I don't use stop losses in mind. And that's what I'm planning to do. So be very careful when you estimate the outcome of any particular trade, because when you come down to individual trades, it's almost random. But when you look at a series of trades, a collection, a group, a population, if you want to be mathematical, population of 30 trades, you can get an estimate. You need at least 30 to get any decent stat out of any numbers. So if you can get 30 trades, measure what you get. But when you come down to individual trades, it's pretty much a coin toss. And even though the setup might look good, even though you might think, well, it's a one up, one down, every time that happens, it's at support. I think we're going up. We've got divergence on the stochastic. RSI is oversold. It's going up for sure. No, you can't ever say that. It may not go up. It may go down. You just cannot tell. So, and that's how traders get into trouble. They see what they think is a dead ringer, guaranteed trade, an absolute cert. Money in the bank is already in the bank, and they put all their money into that trade, over leverage, over commit, buy or sell heaps of cold or oil or futures, whatever it is you're trading, and you look back and you see the market actually went in exactly the opposite direction, and you got caught short or long with too much size, and you got wiped out. I guarantee you, of the 36 people watching right now, there are probably 15. And if you dare put your hand up, I'll count them for you, for the folks that are in the room here. I guarantee there are probably 15 who've been in that boat. So be very, very careful of making those assumptions. Now let's carry on with the questions. Gold. Yeah, I've already talked about gold, Manatee. So you can rewind this at the end, but basically I'm short on gold, having taken profit on my long silver trades, and you'll probably have to just rewind that, I'm afraid. All right. Heiken Ashley candles is good. Yeah, Heiken Ashley is great, Thomas. Just decide what you want to use. If you want to use candles, Heiken Ashley. I mean, there's a whole bunch of different things you can use. And if you use TradingView, let's just open up this natural gas chart. If you use TradingView, you can also use this thing at the top here. Well, to select the display sort that you get. Bars, candles, hollow candles, volume candles. I do like some of these. I like the Renko charts, Heiken Ashley, Kagi charts even, but I don't use them. But this sort of thing's good. This is the Kagi chart, and you get nice smooth. It's this looks like it makes things easy to trade, but this is the Renko chart. It makes it look like things are super easy to trade, because when it's red, you should be short. When it's green, you should be long. But it's not as easy as that, because there's price and time conflicts with these charts. They're not as simple as to read as you might think. But yeah, I mean, they're okay. I prefer to see exactly what's happening with the price. I want to know exactly where the price moved. I want to know what the candle looked like. I want to know what the intent was. I want to know how quickly it moved. I want to know how aggressive it was. I want to know how big it was. I want to know what the spikes look like, whether we've got a candle pattern. I like to get really into the cut and the thrust of candles. And therefore, I don't really pay too much attention to the, I suppose, more boutique type of, they're not candles, but they're patterns, I suppose. So yeah, but yeah, why not? I mean, lots of people, so one of the reasons I hedge is because I don't like using a stop loss, because I think it protects my psychology, and I think it gives me more flexibility. A lot of people don't like hedging because it makes them trade worse. Some people don't care one way or the other. And a lot of trading comes down to preferences, and that's what makes a market. And you'll often find that your ideas may not be unique, but they might be something that you've just pulled out of something, one particular thing that everyone might know about, but don't really pay a lot of attention to. You might just find something like that that's useful for you. Or you might find a particular chart setup that appeals just to your visual eye, something that looks good to you. When you look at my charts don't look like anyone else's charts at all. And your charts won't look like anyone else's charts either. But I have my charts set up because it's pleasing to, you might think I'm a bit of a weirdo but after I've said this, but to me, this is pleasing to the eye. I know exactly what's going on. I know all the levels. I know where I got in and out of trades. I know which candles I'm looking for, so I can glance at this at a glance. And I can read this market. It almost feels like I'm reading a song sheet. I don't read music very well. I used to be able to. But when you read music, it's a very interesting thing. Because if you're a musician, and maybe some of you could comment in here, it would be interesting to hear I play bass guitar, and I have a ukulele too. But I don't read music very well. But those who do read music well can look at a sheet music it's called. He goes, Harley, he knows it's Friday and it's time to not be working. But when you look at sheet music, it's just all squiggles and lines and horizontal lines and little pictures of blobs and with lines and things across the top of them. And some are black, some are not shaded in. It's all very mysterious and strange looking writing. But when a musician who reads sheet music looks at that, they actually hear the music. They don't see what's on the chart or on the sheet, but they hear the music. They hear the notes. So what they see through their eyes gets translated into some sort of primal musical instinct that they have, and they just get it. They understand it. They can picture it. They can immerse themselves in it. And when you get to trading, that's what you need to sort of aim for with your charts. And I often speak to people about this, and they say, well, what are you seeing on your charts? To me, that just looks like a mess. But you will start to, I think sheet music's a perfect analogy. And you will begin to find out that you'll start to look at these charts over time. Once you've done something over and over again, and pattern recognition kicks in, and instinct almost kicks in, you'll find that these charts begin to just speak to you. And you don't have to look at them as much as you used to look at them. You'll just take a glance and say, I know what's going on here. I know where we are on this chart. I think I know where the market's going to go to. And I think I have a strategy in place to take advantage of that. And that's what trading is all about. And when you get to that point where your charts are your own, and they're beautiful, and they speak to you like sheet music, and they paint a picture in your subconscious to you about what the markets are doing and what you should be doing in response to that, you'll be in the right place as a trader. And that all sounds very esoteric, but it's the truth. And I've been around long enough to know that that's how it goes. $3.99 a month. Oh, okay, Michael. There should be a $1 a month. Well, that's what YouTube pays me. Maybe they take $4. I don't know. I have to check that out. Yeah, it's still a bargain. Thanks, Michael. I thought it was $1, but there you go. I get paid. YouTube pays me $1. In fact, 99 cents. So they're obviously taking $3. They're taking $4 and giving me they're taking $3.99 and giving me the 99 cents. That's what they're doing. They give me 99 cents and they keep $3. It's just wrong, man. All right. I think hedging is useful when we're in confusion. Sure. Hedging is super useful, and it gives you time to think, gives you time to pause. You can literally hedge, walk away from your charts, go for a swim, go and have a cup of coffee, go for a bike ride, come back. And when you relook at your chart, if you've hedged, fully hedged, you will not be in any greater risk or any less risk. You'll not be more urgent or less urgent about acting on your trade. You'll be less stressed rather than more stressed, because you won't be worried about the drawdowns, and you won't have had to have taken a stop loss. So you won't be concerned about the money that you lost on your last trade. And you then can look at your hedge and start to figure out a way to get out of your hedge. And that's an exciting challenge in itself. You've got a hedge position like I have. Let's have a look at this one. Let's take the S&P. These are very close to each other, but if these were further apart, let's say this long position was up here. I don't want to mess these up. And the short position was down here. So in other words, I got short there, it went against me, and I hedged over there. When they're that far apart, even though the risk is not growing as time goes on, I've got a fixed risk, a fixed loss, but I've got to figure out a way to get out of this hedge. And that's what's another interesting and exciting part about trading. So when do I take profit on the short or the long? How do I start adjusting these bit by bit incrementally, if that's what I want to do? Or do I just take a loss on one of them and run with the other one? I've done that quite recently on a couple of trades that we've taken. Just ditched one side of the trade and we've gone full in on the other side, and correctly in that case. Not always though. So yeah, that's part of the reason why I've got to find out, I've got to go back to my notes and find out exactly where these were, so that when I show my charts to my members, they don't accuse me of fudging on my positions. So yeah, so I think hedging is incredibly useful. I bought your course and you're going through it this weekend. Thanks, Zed Pepe. Appreciate it, mate. Thank you very much. I appreciate you purchasing my course incredibly. A lot of people trade nat gas because of refund. However, I think it's a trap. The refund, are you talking about the carry, Thomas? I'm not sure what you mean. You can maybe chat about that another time. But anyway, if that is the reason, I think you're talking about a carry trade, basically. If people are trading natural gas because they think it's a carry trade, well, they've got to be prepared to have this move against them by 5, 10, 15, 20, 50% while they're carrying the carry trade, unless ultimately that direction works out okay for them. But it's not a good reason to get into any trade unless you're a carry trader. And we're not carry traders, we're swing traders, or you might be a day trader. But if you're a carry trader, you should be buying, or you should have been buying dollar Japanese yen a couple of years ago and just left it in your account and held it there and done nothing. That's what carry trading is all about. What's the advance of futures markets over using spread betting broker? Ray, I don't know, mate. I've never used a spread better. I'm not in the UK, but I really can't. I'm uninformed as to the rules and the costs and the spreads on spread betting, so I couldn't advise on that. But there is one advantage, of course, and that's you don't pay tax on profits on spread bets in the UK, as far as I understand. And so that's obviously a big benefit. Okay, folks. We've been here for an hour. Thank you for attending. I really appreciate your presence. I'm surprised that 30, 40, 50 people even pitched up on a Easter Friday. So I really appreciate it. Thanks for spending time out from your family, your friends, and maybe your work to be here in the live stream. And I'll speak to you in the next one. And if you haven't joined as a member, please make sure you press the join button now It's $1 or $3 a month, depending on where you live, I suppose. And for that, in return, you'll get these live streams once or twice a month, just for members only. Plus, we're giving away merch. Plus, we're going to have webinars for members, all sorts of things coming up. And my team's busy working on all of that right now as we speak. So I'm super excited about developing this community at YouTube. Click the join button. It's $1, maybe $3 every month. That's all. Not more than a cup of coffee, and you'll get lots of benefit from it. Yes, I could, Michael. I could do one now, actually. I could play. I got my ukulele here. I'll just show it to you before I finish off. You know, I like to, anyone showing interest in my, let's get rid of this. It's not the best one, but it's a rather nice one. It's got a sound pickup here, and it's out of tune because I put new strings on and I haven't tightened them up again recently. So, folks, I'll see you later. Take care. Have a great Easter weekend. It's lovely having you in my live stream. I really appreciate it. And unless there are any other questions, it's until next time. Speak again.
This one goes out to all the day traders, swing kings, and funky quants out there. Strutting in the market with a double screen, indicators flashing like a disco dream. PL swinging, I'm on that grind. Got my spreads tight, execution fine. Slap, pop, sipping on data from the feds. Mouth, yen getting jumpy, dollars heading south. Limit orders layered like a layered cake. Stop, hunt sharks please, I'm wide awake. Oh, what you doing?